Sounds good. All right, folks are going to start joining now. All right, good afternoon, everybody, and welcome to the next in NASEO's Financing Committee call series. We're glad to have you here. We're joined here with three great speakers to give us an update on CPACE. So we'll turn things on over to our moderator, Eddie Trevino, who's going to get us going. Eddie?
Thank you, Sam. Hello, everybody. My name is Eddie Trevino. I am the director of the State Energy Office in Texas. We have a CPACE program in Texas as well. I'm anxious to hear everybody's information as where they are in their program. I can tell you that our program, we have PACE introduced into 109 out of the 255 counties. So we're growing. It's at a slow pace. We have the same issues like a lot of other states in that we are getting CPACE introduced. It's working for as part of mezzanine for larger programs, but everybody's struggling with the small programs as well. So I'm anxious to hear the feedback from everybody. Today, we're going to have three speakers. Let me go over housekeeping remarks first. If you have questions, please put them in the chat box, and we're going to answer the questions after all of the speakers make their presentations. And one thing to remember is that all of the NASEO financing calls and other committee calls are recorded and they are available on YouTube. So if you only catch part of this or you want to listen to a part of a previous presentation, you can go to YouTube and find that previous presentation. Today we have three speakers. Tracy Phillips, who's the director of the Colorado Commercial Property Assessed Clean Energy, is with us today. John Wiley, who's senior counsel with Lane and Green, Michigan, is also with us. And our final speaker is going to be Holly Hudson. She's vice president of finance at St. Paul Port Authority. Let's start with Tracy. Tracy, take it away.
Tracy, are you there?
Hi, everyone. It's Tracy Phillips. You can see my screen okay, Eddie?
Yes.
Yes.
Okay, great. So yeah, I'm going to take a few minutes specifically to the SMB market, the small and medium building market, and some of the challenges around that and some of the things that we've been doing to help address this market and why it's so important. So I figured since I'm the first one to talk of the three of us, that I'd set the stage a little bit about small and medium buildings. The U.S. Energy Information Administration classifies small buildings as 5,000 square feet or less, and medium buildings as 5,001 square feet to 50,000 square feet. So if you look at the population of buildings in CBECS, the Commercial Building Energy Consumption Survey, about 98% of buildings fall in this small and medium building market. So it's a pretty large market, a pretty important one. In the CPACE world, usually when we talk about smaller projects, it's not so much the size of the building, but more the dollar amount being financed. And it's usually $500,000 or less is considered a small project in the CPACE world. So the challenge, one of the bigger challenges with CPACE and the small and medium building market are the lack of lenders that serve the smaller dollar projects. The fact is that smaller dollar projects tend to have unattractive returns for investors. There's challenges with the lean to value, meaning the value of these properties is usually smaller compared to larger buildings, especially if you're in a more rural part of the state. Value of the property can be fairly low. And the fact is that most lenders, CPACE lenders, will provide up to 30% traditionally of a property's value in the way of financing. So that can be a real limitation as well. A lot of rural projects too, where a lot of these smaller buildings are located, are underserved, right? Essentially, a lot of traditional CPACE lenders don't have a footprint in those areas, and so they're not as comfortable providing financing. You know, a project in Denver, sure, they'll finance that, but a project in Lamar, Colorado, they've never heard of that, right? So that can be a real challenge. And a lot of these smaller buildings too tend to are made up with non-traditional asset classes like agricultural is a big one, and those can be particularly harder to underwrite for a lot of lenders. So in Colorado, we've engaged 26 capital providers that are serving CPACE finance projects. So it's a nice mix of different community banks and credit unions, as well as the more traditional CPACE lenders. But what this has really allowed us to do is serve a lot of different parts of the state and a lot of different types of building owners and sizes of projects. So as an example, like, you know, the project I mentioned in Lamar, Colorado, Adams Bank and Trust has, you know, branches right there. So they're familiar. They probably even know the building owner. So I have lenders that can serve different parts of the state and different types of projects. So the reality is, you know, most CPACE lenders usually have a minimum dollar amount that they're looking to finance. $2 million and up is pretty typical for most CPACE lenders. So, you know, community banks are an option and one that we've, you know, like I mentioned, been working to engage. But the reality is, what we've learned, community banks are really not too much different than CPACE specialty providers in as much as they're looking for larger dollar projects too. Usually $1 million and up is what they'll be interested in. So most community banks that we've worked with usually comes down to, for a smaller dollar project, a project that's less than $1 million, they usually want to establish some kind of banking relationship with that owner. So that's usually a condition. They'll say, yeah, we'll finance this project through CPACE, but we want you to establish a deposit relationship with us. So that, you know, that can be a challenge. A lot of times too, the bank will be a mortgage holder of a property, and then they'll be more interested in being the CPACE lender, right? Because they want to serve their customer. So a lot of times that's a nice fit. If the bank is already the mortgage holder and they're a CPACE lender, and that's actually how we recruited a lot of the banks into the program. They were the mortgage holder. We would approach them for consent discussions, and then I'd expose them to CPACE financing, and either they'd say, yeah, this is great, we'll finance this project, or they'll evaluate it and maybe down the road they become a lender. But like I mentioned, in general, you know, banks are not a perfect fit. They really are not too dissimilar from CPACE lenders. So what is really needed are other organizations or green banks that can fill the gap, right? That have an appetite and the ability to finance these smaller projects. In Colorado, we've got the Collective Clean Energy Fund that was fulfilling that role for a while. I won't go into it, but there's been some strained relationships between the Energy Office and the Collective Clean Energy Fund, and so they're not currently financing CPACE projects, which is a real challenge, but I'm hoping that'll change. The other thing to keep in mind too is CPACE is just one option, right? For some projects, you always want to be assisting an owner to look at other financing options as well. So what I really wanted to talk about was one of the big barriers that we see are energy audit requirements for these smaller markets, these smaller and smaller dollar projects. That a lot of energy audit, like a level 2 ASHRAE energy audit, and it's really not in step with these small or medium building projects. What these projects need is really more of a desktop analysis, a streamlined evaluation of a building that just dials in on the improvements that they're interested in. And a lot of it is usually done remotely, like I said, like a desktop analysis. So data is collected via the application about the building. Then you have a kickoff call to talk about the systems that they're interested in evaluating. And you usually want to get utility bills too, if possible, to develop a baseline and look at the rate schedules. And what we've been using in Colorado to support our CPACE programs and in some other programs that I'll talk about in just a minute is a tool we call EPIC, the Energy Performance Improvement Calculator. So this is really, it evolved over the years of us working with CPACE programs and other programs as a really efficient, streamlined approach to doing analysis and presenting a business case to a building owner. So what you have right now, most projects come to us with HVAC retrofit in mind, right? Their heating and cooling equipment is aging. The fact is 5 to 7% of buildings are looking at HVAC replacement every year, right? HVAC usually lasts 12 to 15 years. So every year, 5 to 7% of owners need to make a decision about replacing their heating and cooling equipment. And what they usually do is obtain 2 to 3 contractor quotes. The quotes don't have any kind of energy savings or cost savings associated with them. So what the owner evaluates them on is lowest cost to meet energy code, right? That's it. That's what most owners will do. And we call this the race to the bottom, right? Because they'll select the lowest cost, minimally energy code compliant equipment, and they've missed the opportunity for high efficiency equipment or even evaluating things like electrification or other improvements. Might be an opportunity for them. So with this low efficiency equipment, minimally code compliant equipment, and all of those energy savings and GHG emission reduction opportunities have been lost for that amount of time. So it's a real big problem. Doing in Colorado and in some other programs is using this targeted audit approach, right? A real streamlined using our EPIC tool to analyze specific improvements, not going to visit the building, just getting the data remotely and providing the owner with the business case for different improvements, or sometimes not to do things, right? And a lot of times, like as an example, electrification won't be a good fit for a building owner. So it's better to show them, yeah, this is not the way you want to go. Let's look at high efficiency rooftops rather than electrification. But showing them this analysis in an easily understandable format. The reports that we develop are almost all dollar signs, right? That's what owners understand. They don't know what a kilowatt hour is. They don't know what a therm is or a BTU, but they know what a dollar sign means. So some other things I think CPACE programs need to be considering and things that we've looked at in Colorado. Closing costs are important, right? The reality is there's a certain amount of resources that need to be dedicated to every CPACE finance project, regardless of the dollar size, right? There's certain documentation that needs to be developed and the CPACE process that needs to be gone through. And so you really want to try to reduce or right size these closing costs for these CPACE finance projects. One approach that we looked at in Colorado is spreading these costs, or at least some of them, over the finance term as a servicing fee. So they don't have this chunk of closing costs right up front, but rather it's rolled into the financing as a service fee over time. You also want to try to provide attractive interest rates. So that would mean potentially subsidizing interest rates. As I mentioned earlier, like the Collective Clean Energy Fund, they offer lower than market interest rates and even lower for. equity priority buildings, which again is some properties. And then you really want financing process, right? It's important that you have an efficient underwriting, can quickly underwrite these projects. And you need, as I've been talking about, a streamlined and a level 2 audit's going to kill any hope of originating projects in the small and medium building market. So in Colorado, we've actually 37% of the projects that have been financed in Colorado have been in this small and medium building market, the $500,000 or less. We really have seen since the program's inception that a core component of CPACE's mission is really to serve small and medium buildings and equity priority buildings. And that's really what we've been striving to do here. I'll close it up with some programs similar that we've been applying this approach to, and you can go and check these out. I'll talk about the City and County of Denver, which I've been managing. So the City of Denver has these requirements for all buildings, right? Both small buildings and larger buildings through their Energized Denver requirements. And so we just are wrapping up a pilot program where we worked with 31 buildings in Denver, equity priority buildings, to help show them what the energy and cost savings would be for different improvements and different financing options, as well as other resources that they can utilize. Things like incentives from the utility or state or federal incentives or other resources. And it's really done just like I've been describing, where the City of Denver has been paying for these technical and financial assistance services, which cost considerably less than an energy audit, but provide the owner with that key information they need to make decisions and then actually implement these improvements. Okay, so that's it.
Thank you, Tracy. Our next speaker is John Wiley, Senior Counsel for Lean and Green, Michigan. John, your turn.
Thanks, Eddie. Let me share my screen here. Thanks. So like Eddie said, my name is John Wiley. I'm Senior Counsel with Lean and Green, Michigan. I just want to give you guys a brief overview of...
Not quite popped up.
It hasn't? Okay.
It's in presenter mode, I think.
Gotcha. Let me swap these real quick. How about now?
Perfect.
Awesome. So I just want to give everyone a brief overview of the PACE program in Michigan, touch a little bit on the trends we're seeing, and then I know we're going to get into some questions more later about some changes we've made and what we're seeing with small projects. So just to give you a background, Lean and Green Michigan is the company I work for. We operate, we run, we design the PACE programs for Michigan's jurisdictions. We operate at the county, the city, and the township level. So primarily counties, but we do have quite a few local townships and cities as well. So we've designed the Lean and Green Michigan program model to keep the uniform PACE program throughout the state. We run the marketplace, connecting property owners, lenders, and contractors, bringing the projects in from the very beginning to close, and advertising, holding events, holding trainings, those kind of things on behalf of our jurisdictions that we run the programs for. So a quick map of where we operate. You can see we have pretty good coverage around the state. This covers 81% of Michiganders. So down in the right is Detroit. So you can see most of the counties in that area. That's the big population center. You have a couple, Lansing in the middle of the state, Grand Rapids on the west side, and then northern Michigan is actually a fairly active PACE area. You have some bigger cities like Traverse City. Then you also have a lot of hospitality up there for vacation homes, hotels in a lot of smaller towns. So just a quick run of eligible properties. commercial properties, including residential 4 units and above. One thing we don't do in Michigan that some other states do are government owned, so public schools, anything like that, we can't do PACE on. But for pretty much anything else that's commercial, we've done or we can do. This is probably some stuff you guys already know, but the PACE benefits and why we see so many people reaching out to us is access to capital that is otherwise not available. That's a big selling point for our jurisdictions, as well as bringing private capital in and making much needed improvements that are going to be cost saving over the long term. In Michigan, we follow energy efficiency, renewable, and a new category of environmental hazard. So energy efficiency upgrades include anything that reduces utility charges. Same with water, anything that reduces water charges. Renewable energies are pretty much anything you'd expect, including biomass. We have a specific thing in the statute for anaerobic digesters. We've done a few of those projects. Just in the past year, we've added environmental hazard as a category of PACE that's eligible. So that includes mitigation of certain substances, either in the building or the drinking water, as well as mitigation against severe weather, including flood or drought. Sometimes that's considered called resiliency PACE. In other areas, in Michigan, it's called environmental hazard. We also specifically have a carve out in our statute to allow for electrical vehicle charging and infrastructure. One of the things that we've seen more and more as the PACE market grows, this is both with large projects and with smaller projects, is PACE working in complex capital stacks. Because PACE is called a tax assessment sometimes, or special assessment, people get worried that it's not going to work with certain tax credits. We haven't found that to be true with nearly any tax credits. In a lot of Michigan, especially in urban areas, we have a lot of brownfield projects. So we've seen a lot of projects operate with brownfield and similar tax credits, including obsolete property, OPRA, we call it in Michigan. Historic tax credits is another big one. And we've actually seen these be quite useful on a lot of projects for not only helping complete the capital stack, but also raising the valuation of the building. If property owners are able to obtain tax credits, including some fairly large brownfield or NEZ tax credits, oftentimes those can help raise the assessed value or the appraised value of the property, and thus allowing the PACE to fit in without exceeding our 25% loan to value margin. So as I mentioned, there was a few updates in PACE. It includes the environmental hazard and resiliency, but the other big one is the savings to investment ratio and the savings guarantee. Prior to 2024, all projects that were over $250,000 needed to have an SIR of greater than 1 and a savings guarantee made to guarantee those savings on an annual basis. Post updates, that's changed where that is now a waivable requirement for all projects, except for new construction, which it is no longer applicable for. The new standard for new construction is now measuring savings simply against code, which we've found that change to be driven by the people that it affected. That originally the SIR and the savings guarantee was implemented to protect property owners, to give them some recourse, and to make assurances that they were going to realize the savings they saw. What we saw over the past 10 years or so was that was not something that property owners really wanted, and oftentimes it costed them money to get, or they had to make changes to how they want to design the building. So now we're able to do projects that are still energy efficient, still saving money, but don't have a specific amount they need to save, because we've seen, and I'm sure you guys are aware, different technologies have just different levels of savings you can realistically achieve with them. While some energies have a really quick payback, some have a very long payback, even though they're still they're good technologies, they're good things to implement in a building. So this is kind of allowing us to see more projects that didn't qualify before. It's hopefully making it easier for property owners, making PACE more obtainable, less expensive, all of that kind of stuff. So a little bit of market data for the past about 10 years now with Lean and Green. We've done 88 projects, over 312 million. We've had a pretty good spread around the state. Going back to that map, we do have at least one project in the Upper Peninsula. We have quite a few projects in Northern Michigan. We've seen a lot of investment in Northern Michigan and hospitality. Property values are often pretty high. We do have a lot of projects in the Detroit metro region. It's not surprising. That's where many large residential buildings have gone, office building rehabs, that kind of stuff. but we have gotten a good spread. We've done nonprofits, house of worship, industrial, pretty much every type of eligible property we've done. We've seen a lot of senior living recently. A few examples of projects that kind of are in the lower dollar range. They're still probably what would be attainable today. So not super small, but projects that are really good pace projects. This one is in Hillsdale, Michigan, a rehab of a building back into a hotel and event space. This was a project that we had to get a new jurisdiction on board. So a property owner reaches out, then we go through the process of onboarding a new jurisdiction and to allow them to hopefully not disrupt their timeline very much. And more often than not, we're waiting on others to close rather than they're waiting on pace to close. And then a project we just did last year. This is a large former hospital in Detroit, and it is in an area of Detroit that doesn't have super high property values. It's not downtown or in one of the major touristy areas. So this is a pretty challenging building over time, a nonprofit, which always adds slight complications when it comes to closing timelines and getting approval by the board. This is a much needed project for them. It's a former hospital, now a community health center. They made some much needed upgrades to their internal mechanisms and elevators and everything like that. So like I said, happy to just speak more on what we've seen trend wise, small projects, and answer any questions later. But that's a little update and a background on Michigan's PACE program.
Thank you, John. Our next speaker is Holly Hudson, Senior Vice President of Finance at St. Paul Port Authority. The floor is yours, Holly.
Thanks, Eddie. Welcome all. Hope you're having a good afternoon and enjoying the speaker so far. I will be brief and make sure I don't spend too much time or repetitive information, but I think all of our programs really have something to offer and we can play off each other. So I'll try to point those items out as well. So just to give you an overview, there we go. MinPace, or the state of Minnesota, was really an adopter very early on in the clean energy world. So my predecessor, Pete Klein, in 2009, was made aware of some funds that the state had from the American Recovery Act. So those, I like the Obama era, those stimulus funds. He went to the state and advocated to create a clean energy lending program through the St. Paul Port Authority, and we were recipient of $15 million. That really kickstarted clean energy in the state. We had $10 million for statewide lending and $5 million for Excel territory. Excel is one of the major energy providers in our state to do energy loans. In 2010, the state legislature passed the CPACE law. And so we then had the ability to utilize those ARA funds and PACE together. And that's really made our program successful. I'm just gonna there. And then in 2010, once the legislation adopted PACE, MinPace was created. So the St. Paul Port Authority was named as an authorized authority to create, to review all the PACE loans. And then we have the legal authority to place a special assessment on the property tax bill. So Minnesota is a state where the PACE loan is paid through the property tax bill. And then since we are such an early adopter, the state has really gone through many changes and reiterations to stay up to current practices. I'd like to talk more with John about hazardous and environmental hazards, because I think that would be a great thing to see in the future, but we're not quite there yet. Just to give you a quick high-level overview, so Minnesota legislature passed the law. MinPace, we're the program administrator. We work with all the energy studies, the developers, the lenders, the property owners. We provide information. We place the assessment on the property. We collect the funds. We send them back to the lender. We track the loans. We handle early payoffs. All of those things come through my door. And then we also have a $1 trillion BTU loan fund. So that's where that American Recovery Act dollars came in. So not only can I be a program administrator, I also have a small revolving loan fund that I can tap into, which has really been one of the key parts of the success of the Minnesota program. Just to give you a quick high level overview of what is Minnesota, what's our legislation say. So up to 30% of the property's value, either market value or the appraisal. Loan term is equal to the useful life, a maximum of 30 years. We have to have lender consent, an energy study, and I have too many screens. We are allowed new construction, renewables, energy efficiencies, water conservation or improvement, air improvement, and climate resiliency. We work with commercial. I mean, it's really easier to say who we don't work with. So again, we don't work with governments, and we don't work with residential and condos. So we've never made a condo work, but we have a new building that was a major gut rehab, and they're selling them off as condos. And as they're selling them off, they're paying off the PACE loan. And then the loan is secured and repaid through the property tax bill. So our portfolio, I forgot to mention this in my opening, but I am going to tote this as long as I can. Minnesota leads the country in number of projects, not the value, but number. We have over 450 projects closed to date. And really 83% of our portfolio is under $1 million. A major key part of that has been our Trillion BTU loan program. So you can see here in the lower right-hand corner that the Trillion BTU loan is really catering to those loans under $250,000. So we are in 80% of the state. The green is where we have joint powers agreements, and the red is where we have done projects. As I mentioned, we have over 450 loans closed, 334 million, and that equals to 84 million in annual savings.
Hey, Holly, I don't think we can see your slides.
Oh, no. Okay.
Sorry, yeah, someone else just put that in the chat, and I thought I was going crazy, but yeah, there you go.
Okay. Now you can?
Yep.
All right. I'll go back really quick. Sorry, I should have checked. All right. Now you can see the Minnesota?
Yes.
All right, cool. All right, so so here's the chart I was talking about. So our Trillion BTU loan, over 80% of our loans are under $250,000. This is kind of a breakout by project. So the Trillion BTU loan program has really accelerated the min pace across the state. And here's the joint powers agreements are in green, projects in red. The blue is where we have dual joint powers agreements. There is a rural energy board that operates in the southwest corner of the state. They have a revolving loan fund and tend to do small loans themselves. If there's a project in those areas that is like that they can't service, they will pass it on to me. And then if I have a small one, I pass it on to them in that area. John talked about the benefits, so I won't really get into that. We like to just say that it comes across on the property tax bill, so it's a annual operating cost versus impacting your long-term debt on the balance sheet. When it comes to Minnesota, you choose your lender, so it's an open competitive market. And so I talked about our two hats. We're the program administrators for the PACE program. And then we have our Trillion BTU loan program. Trillion BTU could be a traditional loan, monthly, paid back monthly, or we've coupled it with the PACE payback method. That is our preferred method. It's secured by the property. It works pretty slick. But the two programs have differences. I just wanted to point that out. And so that is some of our challenges. As the min pace statute has evolved, we've become much more flexible. So we've removed the SIR, the 1-for-1 savings requirement. However, my loan program still requires that. And then we also have Davis-Bacon Davis-Bacon prevailing wages reported. Historic preservation approvals is required for my trillion BTU loan as well. So we have some more compliance requirements. We tend to be the lowest interest rate in the marketplace to offset some of those additional costs that or inconveniences that the borrower may have. So I won't spend too much time on this. And then just getting back to how does this work for small projects and how has the Trillion BTU loan program been successful and really driven our numbers over the last 15 years. So really with the 1-for-1 savings, the energy will pay back the loan. So it's cash positive. We work with small to medium size projects from 25,000 to 100 to $1 million. We can only have a 10-year loan term. So that also usually works best with smaller loans. We have over 228 or 288 loans that we've completed. As I mentioned, there are some historic preservation and Davis-Bacon reporting requirements. I'll get a little more into that. And then we also have partnered with Excel. So we've realized that there's different rebates. And so we've tried to work with Excel and say, if you have these rebates, it'll make your projects cost even less. So we work with them to make sure the borrowers know about the different programs or vice versa. In my program, I cannot do new construction or places of worship, but nonprofits does work. So what has driven our success over the last 15 years? Open and competitive lending market. The Trillion BTU revolving loan fund has really driven that small to mid-size loans. We were fortunate enough to get a really large dollar amount, the 15 million. But I would just offer that you can start with $500,000, you can start with 100,000. You can really start, and as you prove out your success, more and more people might be willing to invest in that. We have gotten additional funds from CDFIs, or actually we've partnered with CDFIs and sold part of our portfolio to them to meet ESG requirements that they may have. And the city of St. Paul saw the success of our program and gave us an additional $500,000 to revolve in the St. Paul area. So as you start, you can accumulate the success, spread the word, and get additional funding. Partner with utility companies, offering those rebates, making projects more attractable. We also have participation loans where it's a 50-50 partnership. We also have worked with banks that weren't sure about PACE and wanted to create a reserve account. So we had 2 reserve accounts, and one we just closed. They just realized the success of the program. These loans get paid back, and they closed the reserve account. But we still have one bank that has a reserve account. So what that reserve account does is, if for some reason the payment is late, they tap into the reserve account. Once it's paid, they replenish the reserve. So that is how that works. And then we've been able to sell a portion of our loan portfolio if we want to keep the revolving that loan fund. And we invest back into our program. So we try to we're increasing our marketing, redoing our website, creating a loan management system, and really want to try to make it easier for borrowers and the lenders. And then I'll just touch on quick. So we do our Trillion BTU loan fund. The money came through the Department of Commerce through Minnesota. So it was a pass through to us. So they monitor our compliance. We have hired a contractor who completes the reporting requirements for prevailing wage. She often has pre-construction meetings before funds are dispersed so that we make sure that they will comply with that requirement. We also have Section 106, National Historic Preservation Act, so SHPO. And so that's for buildings 50 years or older or potential land disturbances. That is sometimes a hurdle. And I would say to start the process early and be upfront with the borrower about the length of time that it could take. We have in the worst case scenario, there was a delay of, I think, 4 months. So it was that was extremely difficult. And so the more I can be upfront or go to the SHPO and see if a project is going to flag any concerns, the better. And then I will just, yeah, we have a little time. So these are just some small, I think I have one large, mostly small projects. So this is a building in Minneapolis that redid the facade and lighting and HVAC system. And then this was a unique building that they did all carbon, or I mean, all electrification and carbon sequencing hemp, recycled glass insulation and lighting. So I have not seen what carbon sequencing hemp and recycling glass insulation is, but it sounds really cool and I should find out more. And then here's just a typical solar project. This is also in Minneapolis. And then a large project, this was in partnership with the PACE Loan Group. So they did the Four Seasons in Minneapolis. It was a $20 million CPACE loan. And I will stop sharing now that I finally learned how. Thank you.
It was a wonderful audio presentation, even without the presentation. So you did a good job on it.
Thanks.
I have a question for everybody in that for these smaller projects, how long, when somebody decides that they want to participate in a small project, how long does the process take from beginning where the audit takes place to where you actually fully execute a loan?
I can go first. So I would say it really, that's a hard question. And that I would say it would probably take anywhere from 2 to 4 months to be realistic. Depends on the lender and it depends on if the person has all the information readily available. So as you mentioned, if they have that energy audit, if they have lender consent, they have the application, and if it's coming to me for a trillion BTU loan program, I've closed them as quick as, I think my quickest is 3 weeks. But I take them to my board. So I have an internal credit committee, then I have a board that approves them, then we draft loan docs and disperse the funds. So it kind of depends on timing and how much information is required. External lenders sometimes want county approval ahead of time. So that's going to add at least a month into the process.
Yeah, I'd concur with that timeline. We'd like to say we can get things done in 30 to 45 days on projects. What oftentimes happens is there's a hang up with one due diligence document and that adds a week, and then there's a hang up with another due diligence document and that adds a week. So if there's something that needs to be cleaned up on title or anything, but if everything comes to us clean and it works out well, we like to be able to get things done in 30 or so days. Like Holly said, oftentimes there's a little bit of a slowdown when it comes to getting jurisdictional approval, just because schedule wise, a singular PACE projects, it's hard to fit in their schedule sometimes, and they just pop up whenever. So that sometimes can be a little bit, but we do try to have our documents as succinct and form as possible throughout the state to try to limit the back and forth of trying to make changes to any documents.
Tracy?
Yeah, I concur with everything they said. The two main things that we're usually waiting for, as I mentioned, is the owner figuring out what they want to do, what improvements they want to finance, and then it's the underwriting from the lender is usually the other big. But the CPACE process itself is pretty streamlined. As soon as we get information, we can usually get it through the door. I think the fastest project we ever financed was 32 days, but it's usually more like 60 to 90 days.
And so Tracy, I'll start with you on this question. What needs to happen to help build out the local lender networks?
Yeah, so I talked about engaging sort of banks as you go is sort of been our formula, right? So a bank is a mortgage holder on a project. You need to talk to them about consent. And so that's a way to engage the bank, teach them what CPACE is, and then get them potentially as a lender. I think as I mentioned earlier, though, if we're really talking about addressing the small and medium building market, you need dedicated lenders for that, green banks really, to fill that gap. Holly has her trillion BTU fund, which is a pretty nice resource. It's sort of similar models like that, like a lender that's dedicated to that smaller market.
Just to add on to that, we've had success with a local credit union. And so they've really been a champion as well. So they've closed over 120 different projects in the state. And as I mentioned, potentially selling a portion of your portfolio to a CDFI or to another foundation, or creating that loan reserve fund. And I would echo with Tracy too, as projects come in the door and they need to sign lender consent, I'm trying to bring them on board and have them think about being a PACE lender as well.
John?
Yeah, so I mean, Holly is definitely like a model we try to emulate in Michigan. So I know we've talked a lot with her about connecting our banks with local banks, and that's what we've been trying to do is get local credit unions. But having that infrastructure on the back end of, yes, we want you to be a PACE lender, but maybe they don't want to hold loans for 25 years. So having those pre-arrangements with, and we've actually had some success in talking with other larger PACE lenders who say, we want to do deals in your state. We don't necessarily dislike deals that are $100,000. It's just we don't have the infrastructure to go do 100 of them. But if you have local banks that will do that and then bundle it and sell it to us, we're working on getting those arrangements set up. So having options for banks, I think in talking with some of the credit unions who have done a lot of PACE, they initially think they're going to do that in Minnesota or in Wisconsin. I know they have a lot. And then they like them so much and they're good loans, they end up holding them. But having that infrastructure on the onset to get those conversations started is good.
So there are some states that receive federal funds that want to use their funds for a CPACE program to get it kicked off. What are some of the best practices you would recommend to those states who want to use that money for that purpose?
I would say, as a administrator that runs, what we consider a statewide program, is definitely spend some of the time and along with that money of creating a program that will be generally acceptable across the state. In different areas, especially larger states, you have different areas that have different needs, they have different wants, they have different political leanings. So trying to create a program that caters to all that can be uniform, so you don't have different pockets of the state that have drastically different programs. I think having a uniform program across the state is really useful, because what we found is once developers use PACE, they often want to use it again, but maybe their next project is in a different county or a different part of the state, and they want to be able to use the same program that they used the first time.
Holly?
Yeah, I would say making a successful program with federal funds is just setting up, knowing the program and the parameters and the requirements. We've found some success in also working with municipalities, economic development partners, or regional development offices, because they're really in touch with the people trying to get projects done or in need of that HVAC system that needs replaced and just doesn't have all the cash up front. And so they have helped us make connections, and then they're also usually aware of the different federal compliance requirements. And I guess I didn't mention it earlier, but when historic tax credits are in play, they've already gone through all the prevailing wage and the SHPO requirements. And so that really works well, at least with our trillion BTU program.
Tracy?
Yeah, I'll just echo the idea, just in the vein of addressing the small and medium building market. What I would say they should consider are different technical requirements for these smaller projects, and a lot of programs are recognizing that, but requiring full energy audits for smaller projects, like I've been saying, is just not it's a non-starter for smaller projects. So you have to have a streamlined technical approach and technical requirements that really dial in on the improvements that you're looking at. The other, just in general, I know a lot of programs, like Holly mentioned, still have the savings to investment ratio greater than one requirement, and that also really limits a lot of what CPACE projects and programs can do. A lot of the buildings that we work with, part of their need is on just repairing their infrastructure, right? Like a roof replacement or windows. And these have horrible returns on investment, right? Looking at the energy savings, a roof is about a 250-year simple payback. So, but you ask an owner that has a bad roof, do you want to put in new lights or solar? Or they don't want to talk about any of that until they get the roof fixed. So not having an SAR greater than one is really, I think, an important consideration.
And so, John, I'll start with you on this, on streamlining audit requirements. Where should states look if they're interested in streamlining auditing requirements?
Well, one of the great things that could streamline audit requirements is getting someone else to pay for the audit. So you're talking with local utilities, or the state government. Your local utilities, at least in Michigan, you'll have some requirements to use funds to give back to in certain areas. So if you could start off a project with like a $5,000 jump start by doing the audit and having that information in front of them to show your savings, I think that would be great. We do have a lower audit requirement for projects under $250,000. We haven't seen a project that low in a couple of years, so we haven't got to use it. And we definitely explored changing that dollar amount potentially, but having someone else put the funds up for an energy audit, they, especially local governments or utilities, know their buildings. They know which buildings are using a lot of energy. They know the age of buildings. So doing that for the property owners as a way to jumpstart interest in doing the repairs, and then having a program like the PACE program to fund it, I think would be great.
That's a great idea. I like it. Minnesota does not have a very prescriptive requirement on the energy audit, which makes it a little bit more flexible. But definitely want to make sure we're adhering to best practices and making good PACE loans is something that we want to do. So it's a double-edged sword, really. Like we just need an energy study done by a professional. So that makes it somewhat easy, but to streamline it across the country would be great. And then we'd also be able to have better tracking on how much we're saving and have some benchmarks and comparative data.
Yeah, and I'll just add to what John and Holly have said, and to echo John in particular, state energy offices, if they really want to sort of help address small and medium building markets, like John was saying, earmarking funds, grant funds, or what have you, towards providing free energy audit, technical, and financial assistance services is really key. If you look to the two programs I mentioned that we've been managing, the City of Denver's Energize Denver program and State of Delaware, that's exactly what they did. They had funds that they dedicate to providing these free technical and financial assistance services, this streamlined energy audit, if you will. And I don't even like using the term energy audit. It's just a technical analysis that's applied for these building owners, and it helps them very quickly see what the improvements are that they should do, what the return on investment is, what the financing options are going to look like. So, and just so you know, like the costs of those, we looked at, it's around $2,000 to $4,000 a building to do that approach, rather than an energy audit, which is typically, 10 to 15 grand.
And so Holly, I'll start with you with this question. Are the applicants that you, when you receive applications, is it a first come, first served process? Or does the size of the project influence who gets served first?
For the, I guess for applications, I recommend people establish or find their lead lender. So if the lender is going to be the Trillion BTU loan program, it is first come, first serve. As I mentioned, we do have an internal credit, we do have an underwriting process. And so once they meet those compliance requirements and pass those hurdles, then it's first come, first serve. So it's really, I need that application. I talked to lots of people, but I might have talked to you a year ago, but our loan funds might be running low. And so if you didn't get that application in, I can't put you to the top of the list.
Is it the same for you, Tracy?
Yeah, I mean, with respect to C-base, it's all come, all served, right? I mean, we have all the different lenders, so it's not really an issue. Anybody that comes in the door. I will say though that, reality is only about 20% of projects that start the C-PACE financing process actually use C-PACE and get financed. And there's a lot of reasons for it. Sometimes, consent can't be obtained. Sometimes the project's too small and I can't find a lender for them. Or sometimes, like I said, we're not a hammer and everything looks like a nail kind of organization. We'll show them what C-PACE looks like, but also show them other funding opportunities, and maybe a different funding opportunity is a better fit for them. It all goes towards reducing greenhouse gas emissions, which is what I'm in this business for. So I love it when they use C-PACE, but if they use something else and get the same project done and it works out better for them, then that's great.
Yeah, and just to add to that, we don't necessarily have the same type of revolving loan fund or anything, so it's not limited. It's you come in and we try to match you with a lender. I would love a 20% completion rate on our projects. We get a lot of projects that I know really from the first conversation, they need to replace something in their building and it's $20,000 or something, and I tell them this is probably not gonna to work with what we have available. Let's see if I can refer you to another program. Yeah, we get a lot of projects that come in and I'm able to connect them with a lender and they go from there. And a lot of our projects come from other sources as well, but the ones that come from me, oftentimes are tough ones to fund with the resources that we have right now. So that's what we're trying to do with getting more banks involved.
So the state has additional questions after this webinar is over. Is it okay if they contact y'all directly?
Yeah.
Absolutely.
Of course.
Right. Tracy, thank you. John, thank you. And Holly, thank you. This has been a really interesting webinar and really interesting session. At this time, let me turn the session over back to Sam.
All right. Thanks so much, Eddie. And thanks so much, everybody, for being here. We're looking forward to providing you with more resources as we go on throughout the year. Again, if you have any other questions, feel free to reach out to our speakers directly, or you can reach out to myself and I'll make sure your question gets to where it needs to go. Thank you, everybody, and have a good rest of the week, and we'll talk to you soon.
All right. Bye, guys.
Bye.